It's not just the richest folks, it's the people who are kind of in that kind of 1 to 10 million bracket who run businesses, set up businesses, employ, hire people. If they're leaving, you know, then you lose the entrepreneurial spirit, and so then growth becomes more of a problem. So we need to fix that.
Welcome back, everybody, to our Bond Corner. That's right, we got Reza back in town. How are you, Reza?
Great to see you, sir.
And to you as well. Thank you so much for coming in yet again. Sometimes we invite you in when things are looking dangerous and sort of risky. But what do you think at the moment? How would you describe what looks like rather smooth sailing in the waters ahead?
Yeah, I mean, from the stock market perspective, I mean, you know, the S&P has kind of rallied a little bit since, you know, the concerns over tariffs a couple of months ago. You know, so it's around above 6,200 now. So, you know, I think there's a little bit more, people are looking through a little bit more. So they're kind of ignoring a lot of the bluster that Trump is putting out about tariffs. I mean, there was a bit over the weekend again, you know, the threat of, well, putting 30% tariffs on some blocks like the EU and Mexico, you know, over the weekend. But I think the market's kind of looking through that because negotiations are going on up until the 1st of August. You know, so it hasn't actually impacted the markets like it did the first time around, you know. So Absolutely. Things seem to be kind of stable a bit. So people kind of understand that, you know, this is rhetoric, and then they just want to wait and see what happens and just wait until that point.
Is that from disbelief or actual, you know, the to coin the phrase tackle, that he just won't go through with it? There is no way that a 30% tariff will be applied to Europe on August the 1st.
Well, I think, look, it's important to, if you look back at Trump's first term, the net effective tariff on the world was around 2.5% that he implemented.
Wow.
At the moment, it's 16.6%. So there's a big change, right? People are not baking that into their calculations. So he has really changed the whole nature of trade.
Yeah.
You know, the US is charging, you know, the world a lot more, you know, to enter its market. And, you know, so when people say, is it just bluster, people don't believe he's going to put that rate up. The fact is that the evidence is not bearing that out. So he's actually doing it. And, you know, there is a negotiation going on. Whether it ends up being 30%, you know, is probably not going to be 30% for the EU and Mexico and other nations.
Yeah.
You know, it varies. It's changed for lots of different countries, but
excuse me.
You know, we'll see what happens on the 1st of August. But I think the way the market's reacting is this is just more continual, you know, negotiation, and they don't really know what's going to happen until.
But it's a real two-way pool, isn't it? Because if you see a growth slowdown,
yep,
and the slack in the unemployment factor, that's what Andrew Bailey was talking about, this idea of slack in the jobs market. You see too much of that, we need lower rates in the short term. But if you take tariff rates from 2% up to 16%, then you've got an inflation problem. So Jerome Powell's in a really tricky situation, but that's not the only reason he's in that situation, is it?
I think the interesting thing is people looking at the data, and right now the Trump's advisors are pointing to the fact that consumer inflation is still at 2.5% in the US. It hasn't gone up. It does look like the tariffs are actually impacting the producers, the companies who are importing it. So it's going to come out of companies' profits rather than it being solely just a price increase for consumers, which obviously would push inflation up. So I think people still need to see the data to really work out what the magnitude is, but it does look like it's split between both a price increase as well as, you know, a profit loss for the corporates who are importing.
Yeah. So if we take a look at bond yields now, we see up there the 10-year 4.42 in the US, the 20-year 4.95 and 4.96 on the 30. How would you describe that long end compared with the 2-year at 3.9?
Well, I mean, look, obviously, you know, we've discussed this before, but the longer the maturity, the greater the risk, right? Because there's too many things that can go wrong in between, especially when there's lots of uncertainty going on. You know, short end rates, in my view, are attractive because, look, the US economy is not going to fall over right now, you know. And consumer inflation in the US is 2.4% at the minute. So, you know, technically speaking, Trump's, outburst of the weekend where he wanted to see Powell reduce rates to 100 basis points, the Fed rate, or get out effectively. There is some justification for that, and I actually think one of the plans that is in motion, we'll see what happens. But basically, I do think that with a lot of this stablecoin legislation, like the Genius Act and others
this
that are
week
going in to legitimize regulation around stablecoin issuance in the US, is part of the plan. So I do think that issuers of stablecoins, what they do is they back it with government treasuries, so the US Treasury bills that are issued.
Okay.
So by having a lot of stablecoin issuance, whether it's JP Morgan or others,
you've got a new buyer of
doing
treasuries.
it, you've got a new buyer of treasuries, and that demand will help to bring down short-term rates. And it also, because of the short-term nature, because it's backed, the stablecoins are backed, they can be leveraged and all kinds of things, and so I think one of the strategic plans of this is just my view, the Trump government, is that they are going to use that stablecoin demand, because actually the growth of stablecoin transactions has been increasing quite significantly over the last 12 months. That demand for that issuance, I believe he's going to use that to get demand for short-term treasuries. He's going to force the Fed to lower the rate, and he's going to get some cheap short-term funding, and then hope that the rest of his policies actually engender growth and the tariff revenue does work out the way that he wants. And then kick the can down the structural problem, which is there's way too much debt in the US. Kick that can down the road. So that, I think, is what the plan is. What does that mean for markets? Well, I think what that means is that there's probably a very good chance that the stock market continues to be propped up, continue to creep up for a while, obviously there's a bit of uncertainty to see, but I think that's what's going to happen. I think basically the key thing is that markets want to see, or investors generally, who are heavily invested in the market, the big boys like the BlackRocks and things like that, they want to see liquidity stay there. So you're going to have more of the same that we've had since 2008, which is liquidity pumped in, spending. It will cause inflationary effects further down the road. There will be structural problems because the debt may very well increase. The big beautiful bill, is an inflationary bill effectively, but at the same time, there's also, Trump is also, changing the game by, bringing investment into key sectors like AI from capital from the rest of the world, and also the tariff policy may work out. So we'll see. But
where does that leave the long end though?
So
confused
because I think long term people expect yields to rise, so the long end of the curve, so you should expect the yield curve to steepen.
Okay,
right. So what they're going to do is,
and just take for people that aren't bond experts at home, take us through what that steepening means.
So just think of like a hill, right? So if you think about plot the maturities of all the different treasuries, so you've got your 1 year to 10 year to 30 year, if you think about it on a graph, it's actually the short end, or which is the 1 year to 10 year end, is going to flatten, so it's going to reduce down. So you're basically getting steeper. It's like a mountain which is the incline's getting steeper. The higher rates are going to be at the long end or the 30-year end. So basically, this is what's happening: is that it's going like this. Effectively, that's what's going to happen.
By the 6 month or 2 year going lower on yields, and the long end going higher, because
that's right.
Concerns around the financial health of the US or the inflationary effects, or
so I think most people will realize that it's basically a structural lack of demand for long dated government issuance right now all across the world. You've seen it in Japan. No one will touch a 30-year. It's just, there's a big, actually, the Japanese curve is very interesting. After about 10 years, it really starts to steepen.
Right.
So it goes like this, like that. So there's really a lack of demand at that end. Same is happening with the German bond yields, and same with UK and the US. So basically, we're in a world where long dated government bonds, lack of demand, so yields are going to go up because there's more risk. But basically, a lot can happen in 30 years, if you see what I mean.
And is there any after effect of that? Have you seen that in your career before, where there's suddenly from 10, 15 up to 30, it really steepens?
Up until the last few years, what tended to happen was actually that the long end rates used to be a little bit more stable and actually come down,
Yeah.
because we're just in a different climate now where people are thinking about the long-term sustainability of things, right? So I think what's happening is all the big players and the market are getting accustomed to the fact that governments are going to be funding themselves more on a short-term basis.
Okay.
Like
Yellen was doing at the wrong time.
Yeah. And this is why I think that you should watch the stablecoin space, because what a lot of people don't understand what stablecoins are, but basically, effectively, it's a currency which is backed one for one with, for example, US treasuries, which is the most common thing. So basically, it's asset backed effectively, and that keeps the price stable. So are we
talking like a JP Morgan coin or a McDonald coin?
It could be anyone can issue a stable coin who's going to be authorized by the SEC. I mean, same thing. We don't like him over here. Andrew Bailey doesn't like stable coins, but in the US they're plowing ahead with it, so they're going big into crypto. The reason they're doing it is because it's creating a new asset class to and somewhere for all the money they're printing to go. So it actually keeps consumer inflation down.
Yet again, they've got a problem, and they imagine up a new solution to solve the problem, which then in turn potentially creates further problems.
The interesting thing is that stablecoins actually do have real practical use cases, right? So they actually bring down transaction costs significantly, and so using blockchain rails, decentralized systems, can actually reduce the cost of a transaction to like 5 cents versus like a bank, which is like $25 to $50 per transaction. So you're starting to see even Visa and MasterCard are getting into the action. They've been, Stripers as well, because they all realize that the existing models where people were paying for things on like expensive credit cards, as well as using banks for expensive transaction fees, adds up. If you issue a decentralized stablecoin on running on rails, like efficient blockchain rails, it can lower transaction costs much more quickly, and so there is a real benefit from that, and that's actually why stablecoin transactions have actually increased significantly since 2004, quite significantly actually. I mean, I don't have the numbers off the top of my head, but it's really quite significant. So I do think that's going to be a big area going forward, and obviously the government regulation is moving that way. Now, just one thing it's worth saying is that people thought that was what Bitcoin was going to be, but Bitcoin is expensive, in terms of how long it takes to transact and things like that. It's not using efficient rail
it's not
system.
A payments
it's not really a payment system. It's become more of like a an asset, digital gold, as what they're selling at. So it's represented a new technology, but in reality what it is just now is a store of asset, a store of value. And interesting, that's why Bitcoin's gone up massively, because people are concerned about the dollar, right? And they are concerned, it needs to be propped up. That's what the Trump government is trying to do, is to prop it up, because it has been depreciating. You look at the DXY, it's been coming down. So people are using Bitcoin as a safe haven. Treasuries, corporate treasuries, are actually now buying Bitcoin for their treasuries. I mean, you've seen that, there's people who are raising off the back of that, but just actually regular corporates are actually buying Bitcoin to hold as a treasury asset, like a reserve.
Makes sense. Force me into fiat currency. Or why not?
So I think Bitcoin will continue. The way the policy system is working, the way the big guys want things to go, like BlackRock, is Bitcoin will go up in price. This is for the next kind of foreseeable future. I mean, things can change, but there'll be stablecoin issuance. The short end of the curve, or short-term government bond yields, treasury yields will go down. Hopefully, and so. I think what you should expect is kind of the markets to grind higher, because liquidity is being pushed. And so it's going to be very tough to, short the market right now, even though US valuations are completely out of whack with the rest of the world, right? So if you were looking at, multiples and business value, US companies have higher multiples because of the fact that the US is the most liquid market. It's got the infrastructure. Everyone's been sold that. That's where all the money goes. It's very easy to, buy the S&P tracker and everything like that, on your iPhone or your smartphone. I do think eventually, and I don't know when, there is going to be, it's already started. There's been a bit of a rotation already. There's going to be a bit of a rotation into international stocks.
Yeah. Oh, so, God, we've seen that.
If you look at the outperformance historically, I mean, like the S&P is grown like 5 times the international stocks, right? And that's not simply because there's been great technological innovation in the US and there's big companies like Google and others who've driven the value in the US, of US stock markets, but it's also that there's just a higher valuation applied for US stocks.
Sure. What about if somebody is feeling a bit more risk averse, right? They've seen since April the 10th, they've seen their investment fund, whether it's pension, ISA, SIP, go up by 25% or 35% if you're in the more lively stuff. Say they want to take some of that profit, the amount it's gone up by, and put it into Gilts, for example.
Yes.
What do we think of Gilts at the moment?
Yeah, no. So look, if you're getting more risk averse because you're kind of getting on in age.
Was that a dig?
Well, well, yeah, exactly. But I think it's. I can tell you that the liquidity that's been pumped into the market to keep the stock markets, creeping up at the moment, is to give time for some other big players to, refinance their businesses if they're leveraged or take money off the table. And so, if you're a retail investor, you don't necessarily see that, but this is an opportunity if you are risk averse, to potentially take some money off the table because you've made the gains, on the stock market in the US, and put it into something less risky. I can't tell you when the stock market's going to get to a point, and then it's going to start tailing off a bit. But
we see gilt yields on the screen there. So what options are out there for people that want to get involved in gilts?
Well, so in the UK, for example, look, I mean, I think gilts between 1 and 5 year are very interesting, particularly those gilts which have a low coupon. And the significance of that is that, low coupon bonds mean that you're going to get paid less. You're going to pay less income tax on that, because you have to pay income tax on the income or the coupon. Yeah. Right. So if you've got a 0.125%,
it's as low as
gilt,
that.
right? Some of them have been issued at that level, then most of your return is made up because the price is trading at like 97, or you're in the 90s.
Yeah.
And so it's capital gain, which is going to give you your overall return to get you to, that 4%, yield. And the important thing is you do not pay capital gains tax on qualifying corporate bonds or gilts in the UK. So basically, if you're a higher rate taxpayer, it is better for you to buy a low coupon, so low, which means you pay low income tax, low interest rate gilt in the next 1 to 5 years, 1 to 5 year maturity, because it's basically almost tax free, effectively. Right. And so we on Wise Alpha have that selection. We point people towards it, say, and describe, and actually we've done zero fees as well to encourage people to do that, because, if you can make, effectively kind of 5.5 to 6.5, 7%, some of them for longer dated, kind of gross equivalent yields. What I mean by that is, what is the equivalent yield you would need to get from a savings account in order to generate the same after-tax return? Right. So, gilts are actually better for higher rate taxpayers. Gilts are better than savings accounts right now.
Wow.
So 1 to 5 year gilts are really interesting.
And Rachel Reeves, to speak tonight at Mansion House. Are you off to Mansion House tonight? I can imagine you get the invite.
No, I'm not going to tonight, but I do keep abreast of it. But I know she's got a lot on her mind.
Yeah. And you've got potentially that gap now that she has to fill up. So what do we think UK yields? Would you feel safer in gilts than treasuries, or what way round is the preference at the moment?
Well, I mean, if you're a UK investor, you want to keep it in the same currency. You don't want to take that currency risk. So yeah, I mean, like if you're asking me which is safer, the US or the UK, I mean, to be honest, it's much of a muchness. I mean, if you think about the US is more highly levered, right? Its debt to GDP is like 121%, versus GDP. UK is about 98, something like that, 97%, something like that. But the US obviously has a much stronger, innovative productive capacity. So they can sort their problems out if they do the right things. It's just whether they continue to be greedy, which is basically their problem. The UK, we have a different mindset. We have a mindset of trying to balance the books. So Liz Truss, for example, is looking over jealously at what the Trump government is doing, which is just try and spend their way out of trouble, inflate away the debt. If that's what it comes to. They're obviously actually got some actual real possibility of structural growth, which can help offset that. But in the UK, we don't have that same capability, so it's harder.
She was trying to generate, wasn't she?
She was trying to increase spending, do tax cuts, things like that, trying to follow what was happening in the US. The difference is that we have a slightly different political climate over here, where there's a focus on balancing the books, and so this is the pressure that's on Rachel Reeves. If you don't balance the books, then there's a pressure from the establishment, to push you out, and you don't want to.
Which feels like it might be coming.
Which it might be. I mean, obviously, look, Starmer is, backing her at this minute, after her, a little bit of emotional weakness, which kind of caused a bit, unsettled the markets a little bit. I mean, it's basically people, want to see a chancellor that, has control over the economy, has, confidence in being able to manage the books, and to find revenue and drive growth. And unfortunately, I think the market's a little bit concerned about Rachel's or Reeves' capability of doing that. So we'll see what happens.
And what about if we into more corporate bond market in the UK? Are you seeing anything interesting there? I noticed I got some Punch Taverns cash out.
So the market's becoming a bit more kind of stable. Has actually created a window of opportunity for, UK corporates, as well as obviously the US and the rest of the world, corporates to refinance some of their existing bonds with new bond issuance. So, for example, like in recent weeks, Punch Taverns refinanced at 6.25, or secured bonds, and issued 7.75 bonds. True Potential
7.75%. For a pub chain in the sunshine.
That's right. Yeah, with all the assets, all the pubs that they own. It's, I mean, it is decent. These are, so all of the companies, who are issuing now tend to have, some good qualities, like as businesses. The more riskier ones, they're still going to find it difficult to refinance. But the higher quality companies which are coming to market are able to do that now because the markets are stable. Things like Punch, where it's asset backed, are really interesting, because that's, if something happens to the business, you've got that asset value which can help you recover your money. But they are issuing at higher rates. So people ask the question, so why, if Punch is such a great company and it was only paying 6.25% before, why is it now paying 1.5% more? If it's such a good company. And the answer to that is just because the whole rate environment has moved significantly since they did the original, issuance.
In 22 or...
in 20, it was like 21, something like that. It was original issuance. So basically, inflation has spiked, rates have gone up, central bank rates have moved from whatever they were, 1.5 back then, to like, 4.5, now. So it's basically, that's really why, and that's also a good opportunity. So if you do believe that, rates will come down, at least in the short end, or 1 to 5 year, 1 to 10 year end, then actually what will happen to these bonds, which are now issuing at high coupons, is that their price will go up.
Yeah.
If you think that we're going to go down to maybe 3.5% on interest rates, over the next 12 months, if you believe that,
Which the rates coming down allows the stock market to be where it is.
Yes.
Rates going up, the market crashes 25%.
Sure. Yeah.
So your money's better in bonds, isn't it?
Well,
either way.
Well, so there is an incentive not to increase rates any further, right? Because the global players, the BlackRocks, the advisors to the US government, and the rest of the power players have decided that, we need liquidity in the system.
Mm-hmm.
We need time to, the whole market needs time to kind of sort itself out. We're not going to start hiking,
Unless you're in Japan.
Well, look, unless you're in Japan, that's a different story.
Is because that is one of the questions from Marcus Kane, which is a good question.
Yeah.
That is there Japanese tightening? Does that put significant danger in this plan?
Well, I mean, look, Japan is it's a managed central banking system. So honest with you, the same power players in the US which control US monetary policy control Japanese policy.
Okay.
So they will make sure that, for example, the yen carry trade doesn't unwind, and that short-term rates are not going to jump massively.
The Yellen phone call when it happened last time.
It's not. You're not going to. I don't think that you're going to see a massive spike in short-term rates in Japan.
Okay.
They obviously have a problem with long-term issuance, right? It's like 3.2-ish%, I think, the 30-year, but the spike after 10-year, it goes up quite dramatically. And so the market doesn't want to touch that end. But you're not going to see, I don't think you're going to see, because nobody wants that carry trade to unwind until everyone's kind of fixed themselves, right? I think so I'm not concerned about that. I do think that for example, in Japan, if you're just looking at that, the next election's coming up, they are concerned about the impact of US tariffs. They generally have fiscal concerns over there. That is also going to there's also going to be a desire to therefore keep rates low,
right?
For the time being. So I'm not particularly worried, even though that's
yeah. Okay, we've got some great questions coming in here. So high yield,
yes.
ETF at all-time highs. How are the high yields, and why is that?
Well, the yields that in high yield right now, I mean, if I just take sterling, for example, which is our speciality, you're talking about issuance at 7.5 to 9%. Some have been issuing at, some bonds had been even issued at 10, 11, 12, in the last year. So the yields are high.
Yeah.
And so that's attractive. And the market's stable, liquidity's being pumped in, and so, there's a lot of demand for that extra yield. And so that's why, high yield ETFs are going up. I mean, we've seen over the last 3 months, actually, after the uncertainty of the tariffs has kind of been removed or people don't care anymore, bonds would, had jumped 4 or 5 points, where there was a little bit of concern. I mean, it's not on every case, not all across the board. I mean, some like Ocado, which is actually, has dropped a few points, which is actually a good opportunity. That's because of company specific reasons. But,
right.
I mean, it's, just, we're where we are, when, remember right after the pandemic, as we were in the pandemic, people were very bearish and they were short, but then there came a point where the mindset changed, mm-hmm. and it was like, we're just going to flood the market with so much money that we're going to keep.
And it's still sloshing around.
You got to learn that you can never fight the Fed or a US government who's willing to fiscally buy its way out of trouble. You know, even if it's going to keep pushing the problems back further structurally in the end. So from a market perspective, all assets are going up basically right now.
Yeah, and if we talk about high yields, the main story on the FT today, if we just want to cut to that, catastrophe bond sales. So this is, as you know, we see looks like Steve Irwin in the wrestling a crocodile there. You know, the worries around the natural disasters, insurance companies want to offload these the risks.
Yeah.
And bond yields bond funds are lapping them up.
Interesting. Yeah. I mean, but there's been a lot of, you know, I mean, without getting into the kind of conspiracy theory world, you know, natural disasters seem to be, you know, in specific pockets seem to be quite serious. You know, in general, overall, that it's not like they're massively up, but there does appear to be like quite, when it does happen in some places, it's quite severe, and it's almost as if it's engineered, you know. So I mean, Trump's mentioned that, so we're not going to go there, but yeah,
but
I mean,
the risk is spread around. It says the only ones that have really caused bondholders losses is Katrina, and you know, nothing recently. Touch wood, obviously that continues, but if we're talking about, you know, what we see with the fires and
well, look at, for example, the fires in Los Angeles, right? Before they happened, mysteriously, all the insurance companies didn't want to provide insurance on the properties, you know, just before, you know. So, you know, I mean, you know, Trump noted that. I mean, that's about as far as it's gone. But look, there is generally a trend to take risk off the table when you're a little bit uncertain about climate change. I mean, you know, look, most people understand that, you know, what drives, for example, warming, you know, is water vapor, you know, not carbon dioxide. You know, so the policy, you know, the net zero policy of the Miliband, you know, department, you know, I mean, it's complete nonsense. Right. I mean, it's just nonsense. I'm just going to say that outright, you know, and it's actually costing the UK growth, you know, so I'm actually quite angry about that.
Yeah.
You know,
do you think she might address what can she address tonight that frees that growth in the UK? Is it going to be regulation?
Well, the government as a whole, and, you know, look, I mean, you can start moving away from these growth inhibiting climate policies because it's based on faulty science, you know, and everybody knows it, right?
Yeah.
Both China and the US, which are the largest economies in the world, have like thrown it in the dustbin. You know, the only people who are continuing this strategy or policy is the UK and Europe, you know, because that's where it emanates from. So that you can boost growth by, you know, drilling. You could, if you want, do fracking. I mean, you know, there are lots of other things that the UK government could do to engender growth, and it should. My personal view is that there's plenty of areas that you can save money if you're looking to balance the books, because we do have that mindset over here, than, you know, putting up capital gains tax to 24%, you know, and, you know, allowing the entrepreneurial class to leave the country. Because even if you have the mindset of, well, you know, who cares about a bunch of rich folks, you know, it's not just the richest folks, it's the people who are kind of in that kind of 1 to 10 million bracket, who run businesses, set up businesses, employ, hire people. If they're leaving, you know, then you lose the entrepreneurial spirit, and so then growth becomes more of a problem. So we need to fix that.
Yeah. Any last predictions on bonds or?
Yeah. So, I mean, just to sum up, look, I think, you know, in my space, you know, corporate bonds, high yield bonds will continue to perform well, you know, over the next 12 to 18 months. I think there's some good value there. I think, you know, 1 to 5 year gilts, you know, particularly the low coupon ones, are really interesting for higher rate taxpayers. People should have increased their exposure to that. I think stock markets will continue to stay, you know, the S&P will continue to stay high for the foreseeable future, may continue to grind up. You know, not driven by anything of real fundamental value, just because money's been pumped into the system and there's no desire to change that status quo.
But if you can get 4 to 6% on a gilt, risk-free.
Well, I think there's a window of opportunity for people who are risk averse, to do two things. One, to reallocate to lower risk securities like gilts and corporate bonds, or other asset classes. I think Bitcoin is particularly interesting where it is right now. If you believe that, that is a, I don't know, a safe haven like gold. I think it's worth dabbling a little bit in there. And I think it is worth thinking about if you're reallocating stocks to international stocks where there's a better rating or a better valuation multiple, So that's my view anyway.
Wonderful. Thanks for coming in.
Pleasure to be here.